I asked ChatGPT how to invest like Warren Buffett, and the answers were simple yet also difficult all at the same time. So first, who actually is Warren Buffett and why am I actually even doing this video? Warren Buffett is known for his value investing philosophy and long-term investment approach. He has achieved a compounded rate of return of 19.8%, while the S&P 500 average has returned 10%, which is still impressive. Now, as the chairman and CEO of Berkshire Hathaway, he is one of the best known fundamental investors in the world as a result of his immense investment success, possessing a net worth of $104 billion as of March 2023. That's making him the 5th richest person in the world. Now, here's the first secret to Warren Buffett's success as of ChatGPT, and that is research. Buffett stated before investing in any stock, it's always important to conduct through research of one company's, its financials, management team, industry trends, and competitive landscape as a whole. Now, this can help you make informed investment decisions, which can help you avoid costly mistakes. Now, researching stocks is important for several reasons. Number one, conducting research on stocks can help you make further informed investment decisions, which can help reduce your risk level as a whole. And that helps you identify potential risks associated with the company or the industry. ChatGPT then also told us the reason why Warren Buffett does this is because it helps identify huge growth opportunities. We're able to work out whether the company is either undervalued or overvalued, and through different methods such as discounted cash flow, PE metrics, or free cash flow methods, we can see whether or not this company has huge long-term growth and profitability potential. And this will help improve our confidence as a shareholder, making better decision making, which can then lead to us wanting to either buy the stock further or whether or not we should be investing in it at all. Now, the second secret is strategy. Developing a long-term investment strategy is a habit of successful investors, just like Warren Buffett. And to develop a long-term investment strategy that aligns with their financial goals, risk tolerance, helps them improve and stay calm as an investor. Now, this involves creating a diversified portfolio of stocks across different industries and sectors and holding on to them for the long term. As we know, Warren Buffett is absolutely defined with when we're talking about Coca-Cola, American Express, and Apple as for examples. Now, before developing a long-term investment strategy, it's important to define your financial goals. This includes identifying your short-term and long-term financial objectives, such as either you're saving for retirement, buying a home, or funding children's education, as an example. Now, how we can take this strategy further for you is you need to determine your risk tolerance. Your risk tolerance is an important factor in developing your long-term strategy. Understanding how much risk you're willing to take will help you determine the types of investments that are right for yourself. So what is Warren Buffett's risk tolerance? Well, honestly, he likes to see it as buying undervalued companies actually reduces his risk tolerance. But that still means he doesn't own just one or two companies. His average is between 15 and 20 companies, but that's all dependent on the person and the risk tolerance that you're willing to take. But this is all down to yourself on how risk tolerant you are or how risk adverse you are. Now, furthering the strategy, investing regularly is critical. Regular investing, also known as dollar cost averaging, involves investing a fixed amount of money at regular intervals. Regardless of different market conditions, this can help reduce the impact of the market fluctuations overall on your portfolio, which can help also improve your gains. While we want to do this, we also want to be monitoring the investments at all times, and monitoring your investments regularly can help you make further informed decisions about whether to buy, hold, or sell stocks. And this involves staying up to date on all the market trends, economic indicators, and news that may impact your portfolio, such as earnings dates or looking into their 10Ks. Now, the third secret is outlook. We need to be looking at this from a long-term perspective. Focusing on stocks fundamentals can help investors take a long-term perspective rather than getting caught up in the short-term market fluctuations. And this can help investors make further informed investment decisions that align with their investment goals and also their risk tolerance. To add, this also helps investors stay disciplined. Focusing on companies' fundamentals can help investors stay disciplined and avoid the emotional decision making, which causes so much money which is lost. And why Outlook is so important is it helps improve confidence as an investor. If we've got a further time horizon, looking at the day-to-day fluctuations is only going to impact our emotional decision making. So we want to be focusing on long term, and as we're going to be averaging in every month or however long we want to be investing, then we're able to improve our confidence in the investment as the business gets better and better with the more cash flow they're producing and the greater profitability that the market is going to be making for this company. Now, adding on to that, discipline is key. We want to be sticking to an investment plan that's only going to make us a better investor. We don't want to be timing the market where we think the market's going to go down short term and we're going to sell out of our stocks and try get in at the bottom and buy high. Because guess what? You can never time the bottom. Now, one thing we still need to consider is we need to be keeping an eye on our portfolio. Monitoring your portfolio is absolutely critical, and we want to be aware of any macroeconomic changes or changes within the business where we may need to sell out of stocks. However, if the long-term thesis is still intact, at that point we want to keep averaging in our costs to the point which will only grow in the future. But that can change with many different businesses, and Warren Buffett is always buying and selling certain stocks that he thinks have changed for the better or worse. And that brings us nicely onto our fourth point, identifying potential investment opportunities. Now, monitoring macro trends can help investors identify potential investment opportunities and industries and companies which are poised for growth and are undervalued. Now, opportunity can also be determined through macro trends and evaluating them accurately. Now, determining whether or not the business cycle is in a recession, we may want to switch to defensive stocks such as healthcare or utility. But this is all where being a contrarian is absolutely critical, and it's been one of the main points to Warren Buffett's success. Be greedy when others are fearful is a famous saying that we all know, but we need to act on that. And how can we actually do this? Well, we do this by going completely against the grain, where we need to identify the risks and whether or not they are actually justified. And that's what determines a good investor from a great investor. Investing in companies where things are at the worst, when really they could be better in the future, is what makes a great investor. If you guys enjoyed this video, make sure to drop a like, subscribe if you haven't already, and leave a comment if you want more videos like this. And I'll see you guys in the next one. Cheers for watching.